Welcome to Money on Tap. Money on Tap, your personal finance headquarters, where we bring out the professionals' experience and some fun in what we call three-dimensional investing, utilizing insurance, brokerage, and fee-based planning. That's what we do on this show. We look at all sides of the issues, and we bring a fully independent planning perspective to the table.
Welcome back. You're listening to Money on Tap. You can reach us at 855-226-8551 or info@yourmoneyontap.com. My name is Seth Crossman, joined here with Ben Brayshaw and Dan Mickelin. How are you guys doing today?
I'm doing good, Seth. I'm looking forward to this show, and I think Dan is too. We got a lot of conversation about the market and the world around us, and there's a lot of things moving.
I agree with all that. And you know what? Most importantly, I think the time is now.
Wow, that was good, Dan.
That's a segue.
That's a segue.
Yeah, well, that is the title of the show for you guys. The time is now. And we are, is there stuff going on in the world of finance right now? Am I just not paying attention like you guys are? Or?
Yeah, Fed raised rates again. Who cares?
Yep. Banking system's fine. We'll handle that just well.
Everybody's going bankrupt.
All right.
Yeah. I mean, there's only a couple more bank failures out there. Nothing to worry about, guys, right? You know what? Somebody's going to throw money at the situation. It just isn't me. That's all. That's okay.
Just print some more money. Nothing to see here. Nothing to see here. Just keep going.
I'm so glad you guys figured out how to do that. There was a bit of a problem with the paper the last time we checked in on you. So, anyways, we're not doing that here on Money on Tap. That's not what Money on Tap's about. We are all financial planners with Brayshaw Financial Group. And this is the fun that we get to jump into for the week. And we do three-dimensional investing is what we focus on here, taking a look at all sides of the picture. And as independent financial planners, that's what we have access to is the world of it's almost an infinite world of finance out there. We bring it all together for you because you are the most important person in the room. That is part of being a successful investor. You're showing up. You're doing the work. You're making a difference. And we talk about that here on this show as being a successful investor. And you know what? You can have some fun while you're doing that too, right? I think so.
Well, I think there's a lot of pressure put on people to buy that stock or that investment that's going to just, skyrocket up, and that's how I'm going to make my millions. And, the GameStop kind of investment stories you hear and so forth. And honestly, it's just not the way it works.
And that was not a recommendation, by the way.
And not a recommendation, no, because that's not how it works. So, the problem that a lot of people have is the expectations are kind of, they're not spoken. And so when you don't have spoken expectations, then there's no real declaration that you did what you were supposed to do or you got what you wanted out of something. That's for the same reason whenever you enter an investment, you should really know when you want to get out and what price you're good with. I mean, no matter the day you buy it, like you should have a really good idea of what you think you're going to achieve out of it. And if you get way more than you expected, well, that's wonderful. What a blessing. But if you're really just trying to be an investor and be studious about it, you should have some real expectations around it so you can define success. And when you define success, you know whether you're a successful investor or not.
Yeah, it's very important to anticipate, what the right exit is. What's the right outcome before you make that decision to get in? You wouldn't go and start a home improvement project and spend thousands of dollars without having a vision of what this looks like when you're all said and done. Otherwise, you don't break ground, right? You wouldn't make that first move. And you shouldn't handle your portfolio or investments any differently than that. Have some perspective about where you want to go with this decision you're about to make, because they can all each and every one of them can have a significant financial impact on you long term. So go into it, eyes wide open. And with the right word there, Ben, was expectation of where it's going to get you and when to get out.
I've actually walked into a few houses that made me think of that scenario that you just described, Dan. There was the original house, that Civil War house, and then there was like the next edition of the family created the next edition, and then there was the next edition. And sometimes I was wondering if they ever had a plan or if they just kind of stood back and were like, well, let's grab some wood and go.
See a lot of that around here. It's like, where did this room come from? But it is interesting. So I got to believe that a lot of that was just done out of necessity. And investment's one of those necessities for all of us. again, I've said it before on the show, it's difficult to save your way to wealth. You really do need the might of investments behind you to get there. And, clear vision in and a clear vision out are two important elements of that.
Well, Dan, speaking of saving, you are spitting some serious wisdom this morning, and I'm going to ask you to hold on to a little bit of that for the rest of the show. And in the meantime, we're going to take just a moment here because it's time for Money in the News.
And coming to us first out of Barron's from Karishma Benjani, Harley-Davidson got crushed as bank stock slid. Now it's, in quotes, too inexpensive. And I thought this article was interesting because it hit on something that we've discussed in the past before. But, when the banking industry, hit its slide in the last couple of weeks, and we've talked on the show, and everyone, no matter where you're at, you're hearing about these bank failures. Well, it had the expected effect, you would think, on banking stock prices as a whole. There's the potential that the whole system's at risk. There's this fear. There's this run on deposits and withdrawals. And so people were pulling money not only out of banks physically, but out of bank stocks as well. And it just so happens that Harley-Davidson, like a lot of other retailers and manufacturers, had as part of their umbrella of entities a lending institution, right? You want to buy a Harley-Davidson, you can finance it with them. And the effect on Harley-Davidson stock, as primarily a motorcycle maker, was that it took a hit due to this exodus of the banking world, whether that was mutual funds and ETFs just selling out and individuals doing that. Inside of those buckets of stocks was Harley-Davidson because of this fraction of their business that happens to be in the financing sector. It drove down the stock price to a point where some analysts took a look at it, and I think the PE on the stock, the price-to-earnings ratio, dropped below 8, and they all collectively look at this and say, well, that's a buying opportunity. That stock just got too cheap too quick.
Right. And then there was some reaction to it. I mean, honestly, it's funny. I was just thinking about when we were looking at this article about, I've seen a bunch of Harley-Davidson, storefronts closed down in New Hampshire.
Yeah.
I don't know what's up with the biking world, but I don't know if the, American Chopper show has lost its run or whatever is going on back there. But it's funny, it's the last place I would actually think to go to invest money. But an interesting conversation because, Dan, you and I just instantly started talking about Best Buy and all these different companies that have all these financing and, Macy's the credit card. That, yeah. They have all these other companies that have, banking exposure on some level. And I'm just kind of curious, like how some companies just get hit in such a bizarre way because of something that seems totally unrelated, but they are connected.
Gosh, you're right. There's a lot of companies out there. I'm trying to think of what manufacturer doesn't offer some kind of a credit or have some kind of a credit inside of it like this. And I don't know, at first blush, it doesn't really strike me as anything too worrisome. I guess I'm looking at it maybe a little differently. I'm looking at the price that was, back in 2014, and it was at like 75, and it's down from that. I mean, it's had its kind of glory days and been its own little Wall Street darling out there, and now it just seems to be doing and putting kind of along where I guess I would kind of expect a Harley-Davidson story to be. I guess that's where I'm at with it.
Well, I think Barron's brings up a really good point that it had this somebody saw it way oversold and had a 6% bump, and they were super happy. I'm sure they're probably exiting the stock right now. It's like free money probably, because there's times when stocks are just so cheap for no reason, and they might be like correlated to something associated with, mutual funds and ETFs. I mean, they'll just dump stuff. And it's all interconnected, and then boom, you don't even really you have this kind of unicorn event happen, and it's kind of interesting.
I think both things are true. This banking crisis didn't make Harley-Davidson any worse of a company, but it certainly didn't make them any better of a company. It just created this short-term opportunity that somebody recognized and said, hey, out of all these banks falling, this one shouldn't be there.
Right.
I'm going to buy that.
Yeah.
And like you said, they probably sold it already, in and out. But they made 6% for doing so. And so if you can make that kind of move in a week, good for you.
Yeah, I'm just looking at some of these banks. Some of them crashed and then came back up, and then they crashed again. And it's just they're all over the place.
This is definitely not a comment on banking.
No,
not at all.
Yeah.
Not at all.
Not a place to be playing around with right now, especially with the Fed having raised rates, and we'll get there.
And next to us, coming up to us here, Money News from The Hustle, an article from Zachary Crockett. What the heck are stock buybacks? And this is something that we've also touched on in the past, but this is a little different take on it. And I thought I found it informative on a couple levels. We had a show, months back, maybe a year ago, about corporate actions and stock buybacks is one of these things that companies do, with the presumption, the prior presumption, and they'll be promoted this way, is that the company's got excess cash on the books. It's a good, strong, healthy company. They believe in themselves. They're willing to bet on themselves, so they buy their own stock. And a lot of people will see that news and chase that investment. They'll say, well, if company X is so confident in what they're doing, the state of their finances, and they know better than anybody else, where the stock should be valued, clearly they think the stock's going up. We should buy some of that. But
go ahead.
Not always as you might perceive.
Yeah, I mean, it's incredible because companies want to have the conversation. Oh, our stock's so cheap, we're buying some of it back, and it's it's not always the case. I mean, that's been true in a number of ways. I mean, Apple. I mean, looking at the stock buybacks and the article references this chart. I mean, Apple is the largest company buying back their stock. The next largest company is Microsoft, and it's barely a quarter of the buyback. And we're talking $580 some odd billion that Apple's buying back, and Microsoft's only $172 billion. I mean, Microsoft, come on. But this is the largest buybacks out there. And, you start going through that list, and we were chatting about this, as we kind of pre-show these conversations. I'm stealing Seth's conversation piece here, but, Facebook or Meta, is buying back $116 billion worth of their stock, from the last 10 years. And the truth is their stock is still down, 30 some odd % from its high. But they were buying it back at over 300 and some odd dollars. I mean, maybe 40%.
Their average buyback price was $303, and it's trading, which is somewhere around 200.
Yeah.
So not a good bet by them.
Yeah, not a good bet by them, and maybe not as cheap as they thought it was going to be. But, I'm sure the buys today are probably in their favor. 303 average.
I got plenty more where that came from, Ben. There's a lot of trading strategies out there, folks, and one of them does follow this trend of which companies are doing buybacks. And if you look, there's enough evidence out there to be able to show you maybe that's a strong position for you to be taking with looking at who's buying back Apple, for instance, who's buying back stocks, buy some of that. And that's what some traders have done. One of those that may not have worked out as well might be like your Bed Bath & Beyond, right? That company, one of the things that they did is they got some more corporate debt, and they went and instead of doing other things with that money that they had been telling their creditors they were going to do, they went and bought stock. And guess what? That just completely wiped out the Best Buy, or not Best Buy, but Bed Bath & Beyond stock. Just folks, it's not necessarily what it appears to be. And that's one of the things that's interesting to understand. And actually one of the things that Dan was talking about earlier was how it supports the CEO's income, right? Because a lot of what a CEO's income can be is the stock programs that they're giving them. And so then they're shoring up their income by going and doing stock buyback programs. So it's a wonderful world out there, isn't it? And the more that you know, the more that you can be prepared to, I don't know, buy or not buy. There's actually a ton of information in that article that was a lot of fun to go through. Thank you very much, Zach. We appreciated that. So up next, folks, the Fed, right? That's a topic that we just have dropped with 1/4 point on us. The banking meltdown may have done the Fed's work for it. Interesting. Now, by Nicole Goodwin of CNN. Thank you very much. And so how is that the banking meltdown would have done what the Fed's work? Well, just at a glance, we were looking at just last week, probably the probability of the Fed putting another 0.5% in was looking like the reality. And I think the market was starting to price that stuff in. And now with the meltdown happening, this is giving some of the Fed the information that they're needing to see on their radar to say, wait a second, we're starting to see some systemic things happen inside of our institutions. Banking's a pretty significant one that we all work through, that maybe we need to just kind of hold off a little bit. Yeah, we've still got inflation. Yes, we still have all these other factors out there, but maybe We just need to not go as aggressive as we have been, because that has caused a big problem in some people's worlds today.
Well, I was just going to say, the point of the article here being that what happened in the banking world could stave off the Fed from future reductions, simply because this run on depositors, right, or deposits. So the larger banks probably won't feel this effect, but the smaller and the regional banks.
You mean increases? You said deductions.
Yeah, increases. So the increase in withdrawals, it just makes lending tighter for them, right? They don't have the money to lend it out. That's exactly the same thing the Fed's trying to do is tighten up monetary policy, right? Make money more expensive, harder to get. And so this type of an event, whether the Fed caused it with their rate increases, which we've talked about it or not, it could have the same effect, and it could allow us to not experience the Fed increases, which affect the whole economy on a much larger scale than these bank issues may.
Yeah, I mean, when you really think about it, just kind of in general terms, I think you did a good job. And banks are saying, hey, we talked about this last week. We borrowed money at a lower rate, and now we're fast forwarding a year later, and you can borrow. I mean, the rate we're going to get on those investments went from 1.7 up to 4%. All these old bonds we have, these old treasuries, they're just not worth as much. Man, if this happens again, and the fear is if the Fed continues to hike rates, which they just did again, then we're going to continue to struggle with more and more assets that are getting devalued automatically because the Fed's sending it out at a higher rate. So this is creating complication. I think what's really interesting is this is going to affect our economy on a lot of different scales, because what's really going on is the fear of these banks. They've got responsibility to the depositors. You got one bank buying another bank. Credit Suisse is gone and going to be gone, right? And so banks are literally running around saying, hey, goodness gracious, we don't really want to help you lend more money to a company who's doing great work and so forth, and they can't expand. They can't hire people. They can't do the things that they need to do to meet demand. And yet we have inflation because demand's so high. So now we're potentially creating a whole nother problem that's just going to expand the whole conflict. I just honestly look at this thing and shake my hand and say, I don't know how this thing spins out. And you got Biden saying they're going to back depositors, and that's nationalizing banking as far as I'm concerned. I don't even know how he can say that. We got a banking crisis on our hand. I think it's going to get worse before it gets better. I think buyer beware, big time.
Folks, you heard it here first. You're listening to Money on Tap. You can reach us at 855-226-8551 or info@yourmoneyontap.com. We are talking about the time is now. And, hey, we would just also want to take a minute or a quick second here to thank you, podcast listeners out there, iHeartRadio, Apple Podcast, Spreaker, you name it. Whoever you are out there today, we want to thank you. Also, thank you for the calls and letting us know what you want to hear. The subscriptions, the likes, the listens, all that stuff. We just really appreciate you, and want to thank you for being here with us at Money on Tap today and taking us up on the challenge to grab some money on tap as you're on your spring break, as you're on your hike, your run, and you're out there making this world a better place. We appreciate you taking us with you and learning more about becoming a successful investor, about the things you want to know about what's going on in the world of finance and how you can grow your vision, your net worth, all those things coming together here at Money on Tap for you. We're going to take a quick break. We'll be right back.
Folks, we have a lot of fun doing this show, Money on Tap, and Ben and I have been financial planners for years and years, and our goal here with you is to bring you into the room, have the conversations that we have. We think these are critical conversations for you, but we understand this is a limited space, and what we'd love to do is to open the doors to you with us at Brayshaw Financial Group, so you could experience what it means to have three-dimensional planning in your life. Let's take a look at all sides of your situation, your scenario, and see how we can put together the best plan possible, taking into account your risk. How much can you have in the market? How much do we need to have set aside and doing different things for your life? That's what we do as planners, how we engage with you, and we welcome you to do that with us. You can reach us at 855-226-8551 or info@yourmoneyontap.com. Now, if you have $250,000 that are investable assets today, our planning is free to you. We want you to have the playbook to have a successful experience in retirement. Give us a call, 855-226-8551 or info@yourmoneyontap.com. Ben and I welcome you to Bereshaw Financial for complete wealth management.
We appreciate you listening to Money on Tap with Ben, Seth, and Dan. You can contact us at 855-226-8551 or email us at info@yourmoneyontap.com. And now, more of this week's program.
Welcome back. You're listening to Money on Tap, and you can reach us at 855-226-8551 or info@yourmoneyontap.com. We're talking about the time is now. And what time is that? Right now might be the time for you to go and check us out on a podcast. You can go to iTunes or iHeartRadio, wherever you get your podcast. Grab Money on Tap. Get more Money on Tap. It's what the cool kids are doing. What are we talking about? The time is now for you to ask yourself the question, is it time for me to have an advisor? Or do I have the right advisor? We're going to give you the playbook, folks, and this is coming straight from three professionals, financial planners, fiduciaries in this industry. This is what we do with most of our week, at least, and this is a fun break for us. And a lot of what we talk about are questions from you. You know, we sit down with our clients and what's important, because you're the most important person in the room, right? And we want to make sure that we're clear. We give you a playbook so that at the end of this time today with us, you know what you can go forth into the world of investment advisors prepared to either find the right advisor or maybe take a look at a new relationship, because maybe that relationship that you're in right now, maybe you've just outgrown it, kind of like a pair of shoes. It happens. You know, people level up their investing, and some advisors really work in one capacity well. They did great there, but maybe it's time to open it up and see what else there is. So with that, when is the first thing, point number one, we want to make today. And right now is a great example of when, because market conditions, what's going on with you today or what's going on in the world, in the market today, has got your head spinning. What do I do? Banks are collapsing, or maybe they are or not. I don't know. And rates are going through the roof, or maybe they're not. That's the market, folks. And if you do not stay in touch, it's easy to get left behind.
These are the litmus tests. These like this banking crisis. This is the litmus test of when, you know, you're over your head. That's the first thing. It's also a litmus test if your advisor's over your head. Like, you know, if you're experiencing, you know, these dramatic downturns in the banking world, like, you've got to have a conversation about that. We got out of banking, I don't know, 6-8 months ago. I can't remember when it was. We were completely out of the financial industry directly, like literally the ETF financial sector.
In our portfolios.
Yeah. And I'm just, you know, like, I mean, not that we had some sort of foreshadowing on this, because I don't want to think that like we had some crystal ball or what's going on. But I think of the economist, Mohammed El-Erian, he's from Allianz, and he talks about stuff all the time, but one of the conversations he's had is about Lehman Brothers, you know, and the idea that, you know, they didn't know what was going to happen with Lehman Brothers, but they have conversations about certain things so that when crises occur, that they're prepared to know why they own everything and why they need to get out of everything. And they sold Lehman Brothers long before most of the, you know, competitor investors in the marketplace did, because they already had a decision of what they would do in any event. And he said, we never foreshadowed that was going to be the case. You know, we really try to make that kind of statement, but the reason we talk about market conditions and this banking crisis specifically is that if you have a massive drop in your portfolio, totally unexpected, you got to have a conversation of, are you in the right portfolio? Did you own more risk than you should have had? You know, were you overexposed to one sector? You know, these are where market conditions really create that concern. And I think a lot of people have realized one of two things. Either I own something I shouldn't have owned, I've experienced something I shouldn't have experienced, or I experienced something I can't afford to experience, and I'm either investing this and managing this myself, or somebody's doing this for me and it's not working.
Yeah, I think there's two things that come to people's minds, and this is on the conversations we've been having, because we're getting, you know, more and more calls from people who are seeking advice. It's, you know, first people, you know, that have an investment portfolio, they experience the loss. The first question is, well, why did I have that? And they're upset about it for a moment. But then the second question is why didn't the person I'm paying for advice call me about this?
Yeah.
And why do they allow me to still be in this? And then that's when the phone rings, right? Then that's when they pick up and seek advice from a different source. And again, it's not that we have a crystal ball, but it is that, one of the things that we aim to do is have ongoing conversations with people. And we discuss our philosophy and what's included in our portfolios and why it's there. And we'll take that conversation as deep as people want to get, and that varies quite a bit. But this, proactive approach and, ongoing active management are the things that we offer here that, quite honestly separate us in times like this when conditions, dictate that you can't just buy and hold and sit on it forever. That's not the time we're in right now.
Yeah, and I think there's a whole other aspect to this too, that kind of owning the generic banking world and all of those pieces to it, it just points to it. And it's not about banking. It's not about having owned banking. It's technology stocks and so forth. And, we've started deleveraging out of technology stocks. We actually made some intentional sells there. That doesn't mean that that's where we think the entire market's going. We think we've made decent returns there, and we're happy to take some profits, and we're looking for other opportunities. And this is all part of the management. But I think, Dan, about the number of times we've sat down with people and asked, just curious, like, how did you end up owning this investment? And the blank stares we get, I mean, it's not like, I don't know, sometimes the blank stare, and most of the time is like, well, I don't know, the guy that I was working with bought it, or someone told me about it, or whatever. They don't have like I was looking at the PE and, the RSI, and I felt like the standard deviation of this stock was really appropriate for me. Like no one gives you those responses. I've never had one person sit in my office. So if somebody wants to challenge me, bring it in, come in and have those conversations. That's fine with me. Usually people are like, well, I heard about this, or it seemed like a good company, or my dad used to work there, or it's a company I worked for many years ago. There's usually an emotional, historic connection, but it's not direct research. It's usually just a guesswork.
There's a lot of what I'm hearing is the relationship piece here, and having that connection, having that relationship. And I'm immediately thinking of how many people I've talked to over the last several months that their relationship has been with a robo-advisor, which, if you're not familiar with robo-advisors, it's not a term that we necessarily talk about as much as we used to, because it was a thing. It was a hot topic for a while, and everybody was going into these not everybody, but people were sending their money into these robo-advisors because they're using an algorithm that puts them in the right mix of ETFs and investments for their risk profile, and it's super low cost, and it's easier to, or whatever, that there's a sell around this. People buy in, right, to the idea, and that worked maybe for a period of time, but now those robo-advisors are having a very similar conversation to what we're having. Like, oh, well, now is not the time necessarily to be the passive investor or 100% passive in the market. And they're starting to unwind some of the script of what they were selling 5 years ago as the greatest thing since sliced cheese. And guess what? They're also not necessarily, or they're kind of trying to offer this relationship, but it's at a cost, right? You want to have a relationship now, and it's not just, throw the numbers in the bucket. It's going to have a cost to it. And it's just interesting to hear these people coming through these paths and these learning experiences. We all have them. And in hindsight, thinking, well, what did I learn from this? And where am I at now? And maybe I'm looking for something more.
Yeah, and I think, Seth, you go from robo-advisor, relationship, and so forth. But what ends up usually being, that transition is either the market condition or the life events. That's, it's hey, I'm either outgrown that robo-advisor or that 800 number at, XYZ big, mutual fund powerhouse. And I really want to talk to somebody because either I'm getting married, I've just experienced a divorce, I've got a real estate sale, or, something's going on, or I am on the brink of retirement, and I need someone to solve this income problem that I've got. Those are all the booms of like why we get, injected into someone's life. Like, how can you help me?
Yeah, it's always something that, our conversations tend to start with a problem, So we're called upon to help people navigate that and kind of work their way through it. And the problem isn't necessarily bad news. It's just something has changed, whether it's the market or life circumstance. It's gotten people feeling confused, concerned, and all of a sudden aware that they need some advice. So that's why, to get back to the title of the show, the time is now, right? Everyone needs advice now. And if you don't have that proper relationship or any relationship at all, we welcome you to reach out and give us a call so we can start that conversation. And it doesn't hurt to get to know advisors like us, whether it's us or somebody else, even if today's not the day to make that decision and get all in with somebody. Start to engage the advising community, and you can take your time to find the right relationship so that you are comfortable to move forward when the event occurs. Otherwise, adding this decision on top of a major life event just makes that event that much more complicated.
Just a couple other ones out there, folks, just to make sure that you're in the loop. Have you had an employment change? Do you have elder issues? Is property ownership? Maybe you have some investment property that you're not really interested in changing out the toilets anymore in those. Those are all things that we get to sit down and have a conversation around and come together with a plan. Folks who are listening to Money on Tap, you can reach us at 855-226-8551 or info@yourmoneyontap.com. We're talking about it is the time. The time is now for you to consider working with an advisor or changing up the advisor. So we were covering some of the reasons why or when people start taking a look at working with an advisor and market conditions or life events. And we want to talk a little more about why. And then we're also going to start to give you some of the the sequence of things that you need to be active around. What can you do, or even better, what not to do when choosing an advisor.
Yeah, this is a lot of people think that they build a relationship with an advisor and then that's a lifelong scenario. But I've invariably found that, as people make more money, have different tax concerns, different things going on, just the idea of, charitable giving and how that plays into part as you make more money and how you can utilize that in taxes and be creative. And people say, well, why would charitable giving be a place? Or even leaving a legacy, like you tend to outgrow that initial advisor, and it's a story. I mean, it's part of the conversation. Dan and I, we audit financial planners. We talk to them about bigger picture and conversation, why they're doing stuff and so forth, and we see how people kind of mature into it. But you met your buddy in college, and he becomes a financial advisor, and you start investing a little bit of money, and then you have a 401k, and you grow your assets, and then you hit retirement, and it's like, man, I've got this huge amount of wealth. Am I going to turn it over to somebody who, I know how much irresponsibility they've had in their life too. There's those conversations that exist out there, and I think it really comes down to just understanding how to take the complexity of all the different pieces together, moving from how do I create this accumulated wealth into the, premier perfect distribution conversation that's going to, provide for my full retirement and all of my kids and maybe my grandkids. And how do I make sure I don't run out of money? Like, how are all of these problems and issues summed up? Well, that's where you go to a financial planner. That's where you step in with somebody who has, a wealth of knowledge to be able to figure out each of those things. Meanwhile, all the complexities that come with budgeting and managing through that.
And there's no doubt that different advisors have different specialties, different philosophies, just different ways of doing things. So, yeah, it is worthwhile to take the time to find the right match, right? And why do you get engaged? That can vary a lot. But, one of the things that just talked to Ben is, people that come into more money, right? All of a sudden you have more than you had before, and that creates a concern for you. So that's a why moment, right? Why do you need a financial advisor? Well, because your asset picture's changed. The potential outcomes for your future have changed. Maybe you need a new voice. Maybe you need a different opinion there. But, take that opportunity to get engaged with somebody and start working on what is the right plan for you.
I mean, people have inheritances almost every day. I mean, with baby boomers, there's this the largest transfer of wealth has started, and it's going to continue over the next 20 years. And a lot of people are coming into money, and they've like, I've never had this much money. I have no idea what to do, and how do I make this thing work for me? And we're at some of the lowest tax rates in history, and everyone complains about taxes, and we have more debt than we've ever known, and as a country, and how are they going to pay for that? Well, do you foreshadow a rising tax rate? Well, how do you mitigate that so that you can keep that wealth so it's just not washing away between taxes and inflation all at once?
Yeah, I mean, your 401k specialists who you probably worked with at the start of your career and they've given you good advice, maybe you have a great relationship, but their world is going to be almost exclusively mutual funds, right? And all of a sudden you come into wealth at a different level and you need a more advanced portfolio. They don't, and not to say that they don't for sure, but they don't necessarily have the background on those different tools.
And accumulation and distribution are totally two different types of investment strategies. And if you can avoid making it a light switch kind of event where you're moving all of your accumulation assets now to distribution assets, whatever that might be, whether you're bonds or stocks or annuities or CDs or treasuries, whatever you're looking at, they're different conversations. And if you can change it from being a light switch event into a gradual, change, a gradual shift to creating retirement in a way, it's just so much healthier and potentially a lot stronger.
We all came from different places as far as where we came into the industry. You guys, Ben, Dan, you guys have so much more depth in the insurance side and the annuities and the fixed income and a lot of those spaces. And you definitely have a lot of exposure in other areas of the industry as well. I primarily came from an equities, a wirehouse, stock brokerage side. I didn't even want to talk about insurance when I first got licensed. And then working with you guys and really starting a whole different perspective of what it means to be a financial planner. It's just, you're reminding me of so many of my experiences along this journey where I was in that same boat. I needed to level up my understanding. I needed to grow, and I needed to really get a bigger picture of how all these parts and pieces come together and how significant they are. Because, at the wirehouse, you're not getting long-term care. You're not getting life insurance. You're not getting so many other parts and pieces of what this industry really has a design around, which is you, right? To retire successfully and to have confidence in what it is that you're doing and all of these parts and pieces coming together. So that's a ton of why out there. Liability management, again, that can be insurance, and that can also be, I'm paying off, I've got credit cards over here, at a maxed out percent. Well, maybe you need to take a look at a personal line of credit and minimize that, what you're paying on those cards. There's an access to all these kind of things that we work through. So what do you ask then? You've got a ton of stuff that you've got going on in the background. So you're now meeting with some financial planner. What are the things that are important to be in the driver's seat, have confidence, and know what to be asking? One of the first things that comes up is this: are you a fiduciary?
Yeah, that's a question we hear more and more often. I think we're kind of going through my head of those kind of last 5 or 10 first-time appointments, and that question always comes up. In the 20 years I did this before that, I never heard it once, right?
I know people didn't even know what the word meant.
Right, I didn't know what it meant for a while there.
Even though you were one.
Even though I was one, yeah. It's just terminology I wouldn't have used, but, it's all over the marketing world of finance these days. All of your, commercials and advertisements, that gets put out there quite a bit. And what it really boils down to is, whose interests come first. And in this case, is it the client, right? So that's a fair question to ask. Everybody in our business understands that, and they'll be able to answer that, promptly and right away. And how they respond to that will probably give you some insight to who you're dealing with.
I'd like to add something to that, because there's people out there that say, are you a fiduciary? And, people say, yes, I'm a fee-based only planner, and that's all I do. And, that's and as if, like, if you were anything other than that, you'd be below, that side. As we title, we're three-dimensional investors. We do, commission and fee-based. and insurance. And we do all of those pieces. And what ends up happening is you can find yourself in a, fee-based only investment house, essentially, and truly be as handcuffed as if you were in commission-based only house or an insurance-only investment person. Like, you can be tied right to one type of investment strategy that may not accomplish your goals. And so many people realize, like, you can be a fiduciary, and some fiduciaries only lean on that type of investing, and they don't have relationships to do anything else, or they might not even have the licensing to do commission-based investing, where if you're going to buy Apple and you're, Apple stock and you're 30 years old, you might be something you want to hold for the next 30 years. Well, goodness gracious, you better not do that in a fee-based account, because that's going to be a very expensive relationship over the next 30 years. Where if you did it in a commission-based account, it could be a very profitable relationship in comparison. And you have to understand how those things come into play. And if you're a fiduciary and you hold both of those licenses, you're still tied to do a fiduciary relationship inside of those and justify which one's best for the client.
Yeah, I mean, best interest has a lot to do with best expense, right? But it's not the whole picture. It is not the sum end of that game and that question. So, asking that question and how you get responded to is important. So you want to get that full range of explanation that Ben
you want to make sure that the person is a fiduciary, absolutely. But you want to make sure that their only motivation is not tied to fiduciary management, because you could end up paying a whole heck of a lot more and never realize it if you don't understand what their licensing strategy is.
Which actually runs immediately counter to the rule and the explanation and the definition all at once,
Exactly. It's ironic.
So basically what you're telling me, Ben, if I have one widget over here to sell and I'm a fiduciary, but I only have one widget, then everybody's going to qualify for that widget no matter what. And that is what goes against the understanding of fiduciary, because it may not be what's best for the client.
That's right.
Welcome
Make sure
to
you
government.
got more than one widget out there, folks.
Welcome to the government.
And that ties right into the next question you should ask is, to ask of your advisor, how do you get paid?
Yeah.
Right, which is also a fair question. I know, I was raised in a time in a place where that was supposed to be uncomfortable. You're not supposed to ask things like that of people. But in this business and as an investor, you better, right? You really want to understand that, because that has a direct impact on your bottom line.
Yeah, that's very, very important. I think the other, as we kind of go into what to ask, and this is really, inside crises like this, like you don't want to just move because you like the person, though you have to have a really good relationship. You have to have a good rapport. And I would say that, qualifications, licensing, and experience, our team here, our team has well over a century worth of combined experience. And that's, I think, when you start looking at the volume of people that we have to work with and the experience and the relationships and all the different types of investment work that we do, from tax incentive investing to, whether it's fee-based planning, whether you just want to get a plan or you need some insurance or whatever, whatever that story is, we have those. You need someone to do your taxes. We have someone here to do your taxes. I mean, that's the kind of all-encompassing relationship we have. But we don't all do all of this stuff. We have relationships here, people who do each of those pieces. But you have to understand the qualifications. You have to understand what licensing they have and where that experience is coming from. Because if you're speaking to somebody who has all the licensing you really want them to have, but you don't understand it necessarily, but they don't have the experience in the issues or the concerns that you're trying to solve or deal with, like, it's all for naught. And I think a lot of people, I like this guy, he seems like he knows what he's talking about, but this show is really about helping you ask more educated questions. Do you have experience in retirement income planning? Do you have experience in estate, legacy planning? Do you have experience in building charitable programs that, emphasize those types of concerns I have and inside the legacy piece? Do you have experience? Do you have somebody who can help me do wills and trusts? Yeah, we have someone on staff that can do that. You have somebody who can help me with my taxes because I'm not really sure how these correlate. Yes, we have some. We could actually meet together in our conference room and solve your problem today and figure out what your concern is. We might not get you what answer you want, but it would be the correct answer. That's a scenario a lot of people have. But then and I know I'm taking the mic here, guys, but then it all comes down to investment philosophy, right? I mean, like, if you don't agree with the person and they say, hey, I really want to, buy Facebook, Meta, and put all my money there because they're going to create this 3D virtual world and, all my money is going to be worth a lot. Well, and you're saying to yourself, I'm not sure that I want to put all my faith and assets into my Mark Zuckerberg. I think the guy's a sleazeball. Like you might say that your philosophies don't meet, and if that doesn't work, you need to run because it needs to be a good fit.
Yeah, there's a lot to be said about that, and every once in a while, it comes down to alignment, right? Are you aligned? Are you able to really sit there across the table, shake hands, and understand what it is that you're doing and why, and who you're doing the business with and why, right? And those things come together. When they do, it's awesome. It removes so many of the obstacles moving forward. Folks, you're listening to Money on Tap. We're going to take a quick break. We'll be right back. Thank you also for going out there and subscribing to Money on Tap in your podcast. You can reach us at 855-226-8551. We'll be right back.
For a number of our listeners, they have a lot of questions, and you might be one of them. Today, we're just offering what we call Zoominars, webinars over Zoom meeting rooms where we have top experts, Social Security, estate planning, and financial planning experts for you to speak with, do a private consultation that way today. We're also having webinar-based Zoominars where we're going to have multiple groups where you can be part of that and enjoy that as well. Give us a call at 855-226-8551 or email us at info@yourmoneyontap.com to schedule your Zoominar.
You can reach us at 855-226-8551 or email us at info@yourmoneyontap.com. And now, more Money on Tap with Ben, Seth, and Dan.
Welcome back. You're listening to Money on Tap. You can reach us at 855-226-8551 or info@yourmoneyontap.com. We are talking about what to do. What to do. Well, the time is now for you to learn what to do when choosing an advisor. All right. Are you leveling up your advisor, or are you out there looking for an advisor for the first time? Well, we've been talking about the what to do, and now we are actually going to get into some playbook for you of what not to do. And one of the things that we were just spending quite a bit of time talking about is the fiduciary, right? And how important it is to understand kind of the fullness of what that relationship is, and what that can look like, and kind of how, really understand how people are kind of selling this thing out there too. They're marketing it, right? And that's not a bad thing necessarily. It's what people want to make sure that you're aware of, but they're putting it in a way that maybe separates you from what the whole market has available for you. And because that's the only thing that they're really focused on. They're only doing managed accounts in the market, and that's what they fully believe is the end all be all and the solution for wealth management. Well, there's so much more out here to be aware of, that in a fiduciary relationship, those options, we believe, our philosophy at Brayshaw Financial Group at Money on Tap is that you at least have access, and when those are appropriate, those are presented in a way that empowers you to make a decision, right? And we're clear on what the fees are, what the payout, what the structure is, the reasons why not to. It's a full disclosure discussion for you. And that to us is really what we're talking about. Have a fiduciary in place for you. So don't go out and hire a non-fiduciary would be the don't.
Well, I would say that the don't that I was talking about earlier was that, don't hire a company you can't talk to the same person twice. Oh man, that resonated with me. I don't know why you really got under my skin with that one, Ben, but man. I mean, so many people, they have an 800 number, they got to call so-and-so, and, the market drops, and they're trying to figure out, well, I liked what that guy said, and he had some recommendations. I want to talk to him again, and, well, he's not available, and, we can see it's like, oh, well, I don't have enough money to talk to, like, this Premier League team, and, it's a game. I mean, it's just a game. And honestly, I get irritated because a lot of these big fund companies, they just toss you into a big mix, and, you kind of get trapped inside their stuff, and, you don't know whether to move to another company. You become a number. And I think when you're really focusing on some of the life events, specifically retirement or estate planning, or you're kind of graduating out, or you left one job and you have a retirement plan you need to roll over. Those are the kind of conversations you want to be able to really have some ownership around. And like, you want to be able to talk to that person and understand what the philosophy is and all these different things we talked about, because otherwise it's just a guessing game. And and not that the market has any sort of guarantees in it, obviously, but you want to make sure that like how you want to invest is aligned philosophically, that you believe in those investments and that you believe that to be the right decision and you're prepared for the risk associated.
Yeah, I mean, you just want to have a relationship, right? You want to have somebody you can go to who knows your story, knows your goals, someone you've spoken to in the past, is familiar with what assets you hold, and vice versa. You know what their philosophy is. You know what their advice may well be. Or you've had conversations in the past about, okay, when this happens, we'll do X. When this happens, we'll do Y. Well, if you're just calling into the void of 800 whatever, that's impossible. You can't stay engaged. You may hear, well, we trade notes, we record, portions of these conversations so we can be referred back to. Well, you don't want getting advice to turn into a 3-week process either. You want to pick up that conversation where you last left it immediately, right away, so you can make real-time decisions.
And in real-time decisions, by the time you know it's an issue, like by the time most of the people understood that what was happening with the banking crisis, like we were watching it live stream, like we were making decisions. That's not happening for the average investor, right? By the time they look at their 401k and it's dropped, they're like, oh my goodness, what happened in the market? Why is that happening? The Fed raises rates a quarter a point in response for this, and the market closes, down 500 points. Like, no one knows that's not going to happen. I mean, no one knows that happened today. They don't know how that translated in their retirement plan, because guess what? The mutual funds don't report their values to the end of the day, and you'll see it tomorrow.
Yeah. I mean, with our clients, when two things happen. When something happens in the market, we know who we need to talk to that day. Or when the phone rings, we can almost anticipate why they're calling. Right, it's because we know these people. We know the clients that we work with.
Well, a good example is I literally, a client needed some money. They were doing a trip and so forth. And, I said to him, well, to get the money out and to address the tax issues you have and what's going on in your life, we should take some money from here and some money from here. And they're like, oh, that's perfect. That's exactly what I needed to know. Because we know the story behind them, Dan, as you spoke. And then finally, the last thing here is make sure you've vetted your advisor, right?
You know what? I was reading through our list and I was like, yes, absolutely, vet your advisor. And for me there was a little bit more. And it was just this last week. And I'm going to bring this down into, don't do business with somebody that doesn't listen to you and doesn't, care about you at the level that you deserve. Right? That is important, that they're on your side. And that's probably the step above or to the next level of the fiduciary. And, clients that I met with years ago now talked about their dream to own a piece of property. And it wasn't just any kind of piece of property. They want to have the forest integrated with the gardening and the vegetation and the vegetables, and they want it to be a farm. And it's above my pay grade in this area, folks. I don't know exactly what it is, but I got it. When they were telling me about it, their vision was right there, and it was beautiful. That's what they dream of. And we've been taking care of this nest egg for them to go and do this. And this last week, they sent an email asking me about, saying that they had this possible property and wondering how they could do what they need to do to buy that property. And I'm excited, ecstatic for them. I've prayed about that for them. I want that for them. And then my other question is, talk to your CPA, talk to your tax advisor, make sure that, we're not going to step into some problems if you decide to go this direction with the accounts that we've been saving for you in this. So, folks, it's that level of relationship. Do you have that level of oversight, of care, of understanding of who you are, what your values are, what your mission, what your purpose is? It needs to be a part of this advisory relationship. It's that important, folks. So this has been a lot of fun for me. Thank you, Ben. Thank you, Dan.
Thank you, Seth. Hopefully you're in that position to find the advisor and agree that the time is now.
Absolutely.
That's going to do it for us at Money on Tap. You can reach us at 855-226-8551 or info@yourmoneyontap.com. Folks, be successful in your investing. We cannot wait to be here with you next week.
The views expressed are not necessarily the opinion of this radio station and should not be construed directly or indirectly as an offer to buy or sell any securities mentioned herein. Investing is subject to risks, including loss of principal invested. No strategy, product, material, or tool mentioned can assure a profit nor protect against loss. Please note that individual situations can vary. Therefore, the information, products, materials, or tools mentioned should be relied upon when coordinated with individual professional advice. Past performance is not a guarantee of future results. This show may be subsidized in whole or in part by a product sponsor or issuer. Securities and advisory services offered through SagePoint Financial Incorporated, member FINRA SIPC, and a registered investment advisor. All other services offered through Brayshaw Financial Group LLC are independent of SagePoint Financial. SagePoint Financial and Brayshaw Financial Group do not provide tax or legal advice. Main office is located at 116 South River Road, Bedford, New Hampshire, 03110, and can be reached at toll-free 855-226-8551.